The next section deals with organizational form. And we'll look at three different types of organization. The easiest is a sole proprietorship. It's your business. So you start a business and you call it ABC Co., but it's really just you. The ease of formation is very easy. You just kind of file a name that I will now do business as. That's what DBA is. Do business as ABC Co. Legal aspects, also very easy because there is no owner other than yourself. There are no contracts necessary. Regulation, pretty minimal. You still have to adhere to being an honest and law-abiding business person, but nothing special for the formation. Taxation, you're taxed as an individual right now, and if you have a company in that is your alter ego, ABC is essentially you would be taxed at your individual income tax. So that's also very easy. Lifespan, this is a problem. You die, it's over. So it's completely tied to you, and of course that goes for the life of you and the entity. Personal liability, here's the big problem. Unlimited. Something goes wrong, you get sued, or somebody is damaged by your product or your service. You would then be exposed for everything you own to make good on whatever damages you cause another. Next is access to funding. It's limited because there's not as much security. It's just you. If something goes wrong, the banker or the shareholder won't be as protected as if there were more substantial borrower involved. So on the right side, we have some comments. It's your decision. It's easy. No filings are needed. Just general laws of good commercial behavior. Taxation is just your own individual tax. And you are the company. And the obligations are personal, even though you may have taken it out as ABC. ABC is you, so therefore it is a personal liability. And access to funding is just as if it's your money. And if you could borrow money, your entity has money. And converse is true. If you don't have access to money individually, forget about it for your sole proprietorship. Next is general partnership. On very top, I put avoid because I've gone through quite a bit of heartache and headache and financial risk in general partnerships. So they're dangerous. They're fairly common and they're easy, but they are legally very risky. So using the same attributes, formation, pretty easy. All it takes is a couple of people to agree to do business together. A handshake is almost sufficient, not advisable, but sufficient. Legal aspects, you should have a written agreement. Note the word should. Again, you could do it on a handshake, but people have a convenient loss of memory when things go awry. So write it down. Next is regulation, minimal. There is a uniform partnership set of laws, but other than that, it's fairly straightforward. Taxation, it's a little more complicated because you have more than one person that owns the business, but you just split it up according to their ownership typically, and everyone takes their share and pays their tax. And lifespan of company, it's again an issue because if there are two of you and one dies, then we have a problem. So this is one of the issues of partnerships, is that what happens if someone passes away or otherwise leaves the partnership. And a comment here is we could mitigate it by having buy, sell, or other mechanisms in the event of a partner exiting. Personal liability, unlimited. This is why it's bad. So let's say you and three other friends form a general partnership and somebody slips and falls in your store and they sue you. Well, if you don't have adequate insurance, then the liability falls on the partnership. So that's bad because each of the partners would be responsible. It gets worse. What happens if you're the only one with money? And even though you only own 25% of the company and your other three partners own 25% each for the other 75%, what happens if you're sued for $10 million and nobody has money except for you? You can be held liable for all of the liability, all the $10 million if you have it. Then you would have to sue your three partners to get back your share from them. So that's why general partnerships are very, very dangerous. That it's personal liability at all is bad news. But furthermore, for those with more assets, they're actually at more risk than those with less assets. So there's a lot of bad things to do with liability aspects of a general partnership. In other words, avoid it. Access to funding, limited. There are more people there. There's more collateral, more guarantees, more people. So it's a little bit easier than getting an individual. However, there is not as much as you would see as a corporation, which we'll see in a moment. Now, there is a way to mitigate the problem with liability, which is the main problem of partnership. This is a little bit complicated graph. All I've carried, the first two columns are right here, and have added these four. These two columns represent limited partnership. It's a little bit more complicated than a general partnership. And the basic idea of a limited partnership is that you have one general partner, and then all the other partners can be limited partners. And by virtue of them being limited partners, they can only lose the amount of their investment. They can't lose any more money beyond that. That's the huge advantage to a limited partner. Now, the limited partner has to behave a certain way, cannot be active in the business, cannot make major decisions, basically is a provider of money to the general partner, if you think about it that way. And therefore, the liability is limited because the degree of control in the business is limited. That's the general notion of a limited partner. But it's effective. So and these are very common in real estate. One partner is the expertise partner who puts the whole thing together. The other people are the money partners. They put money into the real estate investment, and they could lose that amount of investment, but nothing more. If the project goes well, the general partner makes a little extra return on investment because they did more work and took more risk. But then the limited partners also make a good rate of return as well. So that's a very successful and well-used way to finance a real estate investment. Legal aspect, now we have to have a written agreement because we have to differentiate legally the requirements and responsibilities of the limited versus the general partner. Regulations, same as general partner, basically, partnership law. Taxation, same as general partnership, but it's basically by agreement on who gets how much of the tax attributes. Lifespan, same issue. What happens when one person passes away? You have a buy-sell agreement or other ways to deal with maintaining or continuing the partnership. Personal liability, this is the big advantage. One person, the general partner, has risk. The others have protection. It protects all but one. So that's a nice attribute. Access to funding, a little tougher because now you have fewer people to go after. So if you're a banker and you lend to a general partnership and there are 4 partners, you can go after any of the 4. If you're a banker and you loan to a limited partnership, you can only go after the general partner. So if there's 1 general and 3 limiteds, you can only go after 1. So it's quite a bit less security for the banker and therefore less attractive as a loan for the banker. The last 2 columns represent variations called limited liability corporations, limited liability partnerships, and these are usually used for professional corporations or professional groups, such as law firms, consulting firms, CPA firms. Very, very common form. And the difference is that they won't have a formal GP relationship. They would have managing members. The use of terms is quite different and very similar other than the legality of the general partner. It's cleaner for professional corporations to operate in this basis. It protects their liabilities and yet allows them to share in the profits of the business. So those are partnerships, general, limited, and limited liability partnership. Third is corporation. This by far is the most common in the US, and it's because the commercial side of the business is geared around a corporate entity being the business itself. So again, using same attributes, ease of formation, a little more work to incorporate. You have to do filings, you have to adhere to corporate law, state law. Legal aspects, there are more documents to file, same as the ease of formation attribute. And in regulation, there's more law, again, state and local and federal for corporations. Taxation, this is the ugly one for owners because you're taxed twice. What we mean by tax twice, tax once when the corporation makes money, and then if the company distributes money to its shareholders, the shareholders are taxed again. So taxation is double, once at the income at the corporation level and again at the recipient, namely the shareholder, whether it's a dividend or it's a liquidation of the shares. Lifespan, this is a positive for a corporation. It is its own entity. It's not a person or a group of persons. It is an entity that has shareholders, so it has unlimited life. Personal liability, there's no personal liability. That is, again, one of the big advantages and why this is so popular is that in general, a person who sues the corporation cannot go after the individuals who own the company. and access to funding is improved. This is the most common form of funding for bankers, for bondholders, for investors. So this is very common ground. Now, what if we want to find a way to get around this little tax problem, around this issue of being taxed twice? We can do so because in the United States, there's a special provision in the Internal Revenue Code called Subchapter S. A regular corporation is called a C corporation. If you're a corporation but you want to elect a Subchapter S status, you have one huge advantage. That is that you're taxed once. So rather than having taxes paid at corporate and then again when you distribute, a Subchapter S corporation will take the income earned by the corporation and distribute that and have it taxable to its shareholders. Now, the shareholder pays that tax, but will not have to pay taxes on the distribution of dividends. So therefore, it's single taxation. The reason the IRS and actually it's US Congress put in place Subchapter S is not a loophole. It's actually an inducement or an advantage for the formation of business. If they made it too hard for companies or less advantageous for companies to form, there would be less companies formed. So this way enables companies or individuals to form companies, grow businesses, take more risk, and shelter their own personal liabilities, and also reduce their tax burden compared to a regular corporation. The reason it's put in place is for small business. After a company gets a certain size or has a certain complexity of ownership, they can no longer retain its special Subchapter S status. They'll have to revert or convert to a C corporation and pay more taxes, pay double taxes. But for kind of early stage or for smaller corporations, it's fine. They could stay Subchapter S through their entire existence. Now, there's a new kind of corporation that is not uniformly available in the United States yet. Let's say it's about half of them. It's called a benefit corporation. And here I want to point out that there was a slight inaccuracy in the book, and I'll tell you what that means. So I call this alphabet soup. We have C Corps, S Corps, and with something that people are tempted to call the B Corp. A benefit corp is a for-profit corporation. However, they also have social responsibility or environmental objectives. So there's a social impact investment, and that's why it's called a benefit. It's a social benefit corporation. Now, the reason of the inaccuracy in the book is that the book takes a shorthand and calls it a B Corp. Fortunately or unfortunately, there is a copyright on the term B Corp by Certified B Corp, which is run by an organization called the B Labs. And a B Corp is a company or is a designation when you comply with certain requirements to be a social benefit company. It's best to call them Benefit Corp or Certified B Corp. So there's no ambiguity. If you simply call it a B Corp, some may think it's a benefit corp, or some may think it's a certified B Corp. That's a little bit too complicated for most people. So just remember that when you hear B Corp or variations thereof, it's a company that's for profit, but is really formed to do something good in addition to making a lot of money for its shareholders. So let's say you go from a corporation, you get larger and still need capital. So that's when we go to the public market. And IPO is something I'm sure you've heard of, initial public offering. It's when a company changes its status from being a private company of just a few shareholders to now being available to be sold and bought every day on the exchanges. And you're now publicly owned as opposed to identified individuals that have put chipped in money together to form your business. So once you're registered, the big advantage is now you have access to all capital markets. And it means you could sell more common stock, you could sell preferred stock, you could sell bonds, you could do fancy financing instruments. It is advantageous for large companies who want to take advantage of the full suite of possibilities of financing to be a publicly traded